What's up, YouTube? How confident are you in your ability to build wealth? Have you mapped out your path to financial independence? Have you been told that you need to be invested in the stock market in order to help secure your financial freedom, but you don't know enough about how the stock market works to feel comfortable getting started? Well, if any of these things apply to you, then you're in the right place. Welcome to my channel, or welcome back if you've been here before. If you're new to this channel and you find the content useful, then please take a moment to subscribe, and don't forget to also hit that notification bell so that you will automatically be notified when new videos are published. Don't worry, you won't get any annoying emails or anything, just a notification that a new video has been published. I publish a new video lesson each Saturday, so if you're not already subscribed, why don't you take that first step towards financial independence and join me here each Saturday? You won't regret it. Man, I gotta tell you, I am super excited about what has been happening lately with respect to the stock market. Now, I'm not talking about whether stock prices are going up or down. I'm referring to the increasing involvement of individual investors. For years now, I have been working with and teaching individuals and families how they can build wealth using the stock market. I've also worked hard at educating people on the fact that in order to build wealth, you will likely have to change how you think and behave when it comes to managing all aspects of your money. Everything from managing your credit score, to efficiently utilizing and managing debt, to planning for retirement, and even controlling what happens to the assets you've accumulated after you are gone. You see, far too often we don't realize that our biggest obstacle to success is our own behaviors. Shifting our thinking from a consumer mindset to a wealth building mindset is not as hard as you may think, but it does require some effort on your part to acquire certain knowledge and then put that knowledge to good use by developing new financial habits or behaviors. And that leads me into our lesson for today. If you're going to invest in the stock market, and you should, then there are some things that you need to know and understand about how the stock market works in order to make the most of your investments. There's a lot of terminology that gets tossed around when people are talking about the stock market, and I'm not going to try to cover everything here today, but I do want to touch on a few of the more important terms and what they mean to you as an investor. The first term that I want to talk about is shares outstanding. Shares outstanding refers to the total number of shares of a company's stock that is currently held by all of its shareholders or investors. Everyone that owns stock in a company actually owns a piece of that company. Companies issue or make available for trade shares of a company's stock in order to raise capital to finance business operations. Now, companies also use both long-term and short-term debt to manage their finances as well. The number of shares outstanding is not static, meaning it doesn't stay the same, and it can actually fluctuate pretty wildly over time. Sometimes a company will issue more shares when it needs to raise capital, and sometimes companies will buy back shares of its stock for a variety of reasons. One reason the number of shares outstanding is important to you as an investor is because that number is used to calculate other important measurements of a company's value, such as earnings per share, which I'll talk about in just a moment. Large, well-established companies can have huge amounts of shares outstanding. Amazon, for instance, has roughly 500 million shares outstanding. If you think that's a lot, then take a look at Apple. Apple has almost 17 billion shares outstanding. Now, you might look at those two numbers, 500 million versus 17 billion, and think, wow, Apple is way bigger than Amazon. Well, it all depends on how you look at the numbers. If you look at market capitalization, or market cap for short, which is one way to measure the size of a company, you would see that the difference is not as large as you might think. Market cap is calculated by taking the number of shares outstanding and multiplying it by the current stock price. So in the case of these two giants, Apple has 16.7 billion shares outstanding, and its stock price is around $135 a share. That means Apple has a market cap of about $2.2 trillion. Amazon, on the other hand, only has about 500 million shares outstanding, but its stock price is around $3,270 per share, which gives it a market cap of about $1.6 trillion. Now, those are big numbers regardless of how you look at them. But just know that companies try to manage the number of shares outstanding for a variety of strategic reasons. Some companies try to keep their stock price within a certain range in order to make it affordable for more people, while other companies may be more focused on shareholder value, which leads me into the next term that I want to talk about today, and that is earnings per share. Earnings per share, or EPS, is calculated as a company's net profit divided by its outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. Earnings per share indicates how much money a company makes for each share of its stock and is widely used as a metric to estimate corporate value. A higher EPS indicates greater value because investors will pay more for a company's shares if they think the company has higher profits relative to its share price. So which of our two giant companies that both start with the letter A do you think has a higher EPS? Well, if you said Amazon, you would be correct. Amazon has an earnings per share of around $41. Apple, on the other hand, has an earnings per share of around $3.69. So does that mean that Amazon is a better value for you? Well, maybe. If you're already an Amazon stock owner and you bought it before the stock price got so high, but I doubt if many new investors would view $3,000 a share as a great value. Actually, both of these companies offer value in different ways, but as a new investor, you don't want to be trying to buy individual shares of either of these companies. A more affordable way to invest in these companies is to find a mutual fund or ETF that has both of these companies along with many others as part of its holdings. Now, earlier I mentioned that companies try to manage their number of shares outstanding for a lot of strategic reasons. I want to go back to that point for just a moment to illustrate why you need to shift your thinking and behaviors from a consumer mentality to a wealth building mentality. As you have seen, the number of shares outstanding a company has affects the earnings per share. And earnings per share is a measurement of perceived value. So sometimes a company will buy back shares of its stock in order to decrease the number of shares outstanding and therefore increase their earnings per share. When the pandemic hit and Congress was working on a stimulus package, one of the provisions that was included was that companies could not use the funds to buy back their own stock. Now, the reason this came up was because during the last financial crisis, when the government stepped in to bail out companies, a number of those companies used some of the bailout money to buy back their own stock and increase their earnings per share, which would in turn increase their perceived value and attract more investors. Now, if I view that with a consumer mentality, then I'm thinking, well, that's just great. My tax dollars are being used to bail out companies who are trying to increase profits for its shareholders. But if I'm invested in the stock market, and you should be, then I'm looking at things from a wealth building perspective. And my view on that might be, okay, some of my tax dollars went towards protecting my investments. I can live with that. Look, I know not everyone will agree with me, and I welcome your comments on the subject. But the fact of the matter is that we live in a capitalistic society, and you can either benefit from that process or you can be a victim of that process. It all depends on your mindset and your behaviors. One last term that I want to touch on today, and that term is price to earnings ratio, or PE ratio. The price to earnings ratio is a ratio for valuing a company that measures its current share price relative to its earnings per share. PE ratios are used by investors and analysts to determine the relative value of a company's shares in an apples to apples comparison. Now that's apples as in fruit, not apples as in iPhones. PE ratios can also be used to compare a company against its own historical performance. To calculate PE ratio, you simply divide the current stock price by the earnings per share. So let's go back to our two big A companies. Wait, was that a Freudian slip? Never mind. So if we look at Apple, we would see that it has a PE ratio of around 36. This means that its price is 36 times what its earnings are. So is that good or bad? Let's look at Amazon first and then we'll answer that question. Amazon has a PE ratio of around 78, meaning its price is 78 times earnings. Well, if 36 was bad, then 78 is twice as bad, right? But what if 36 is good? Does that mean 78 is twice as good? Well, the answer is you can't say if either of these numbers is good or bad based on the information we have. Remember, I said PE ratios can be used to compare apples to apples. Well, this is not apples to apples. This is Apple to Amazon, and they are not like companies. But if you compare Apple to a company like Microsoft, for instance, you would be comparing two technology giants. In case you're interested, Microsoft also has a PE ratio of 36. Just a coincidence. But similar companies do tend to stay in a similar range when it comes to PE ratio. When you see a company's PE ratio start to get too far above its normal range and there's not a good reason for it, then it probably means that that stock is overvalued. This could mean that it's a good time to sell depending on your stake in the company, or it could just mean that it's not a good time to buy this particular stock. Either way, understanding what PE ratio means and how you can use it to evaluate the stock of a company helps you make more informed decisions about your investments. Well, I hope this information has been informative, and I hope you can use at least some of it to help shift your thinking about the stock market. Listen, I'm not trying to turn you into a stockbroker or a stock analyst. What I am trying to do is clear up some of the mysteries and fears about the stock market. Because if we don't understand something, or when we fear something, that is what shapes our behaviors around that thing. When we remove the barriers, we clear the path for new behaviors. And you know what I always say, change your behaviors and you can change your life. Make sure you're subscribed and tune in next week for another lesson in this series on stock market basics. Stay safe out there, and until next time, behave well.